Let's continue the conversation surrounding the Fed's rate cut, a path forward. And we just spoke to Chicago Fed President Austan Goolsbee, saying that inflation is on the path to the Fed's 2% target, but won't, quote, tie the committee's hands to a policy decision before getting more data. Investors, however, are getting more and more convinced of a September rate cut, with odds near 100% on the CME FedWatch tool that we will see a cut in September. Joining us now is Stephanie Roth, Wolfe Research chief economist. Stephanie, it's great to talk to you. So let's start with some of the commentary that we just got from from Chicago Fed President Austan Goolsbee, and I want to start with his comments on the labor market, because I think that's coming more and more into focus. Yes, we have made some progress on inflation, but we are starting to see some weakness in the labor market here, and the latest just being the jobless claims report that we got out this morning. I'm curious if you agree with him just in terms of the fact that it is raising some red flags, not too much to be concerned about yet for now, and it still seems like we're nowhere near a recession.
Yeah, and I think that's totally fair. He talked about early warning signs, and the Fed is clearly starting to get a little bit more concerned about some of the labor market data that we've seen. So far, they're calling it a sweet spot, but they just don't want to see things deteriorate further from here. So it's prudent to start talking about rate cuts, and kind of in our view, the most likely rate cut is going to be in September, and the chorus of Fed speakers have been alluding to that. I do want to flag on the unemployment claims data today. Some of the jump appears to be driven by the hurricane in Texas, so it is probably exacerbating some of the trend that we've seen. But if you take a step back, we're starting to see the labor market conditions soften at least a little bit. We're now looking back towards where we were in 2019. Beverage curve is back towards the last, where it was the last time, so kind of back to sort of normal types of, the relationship there. Quits rate is back down even below where we were at its peak in the last cycle. So we're really starting to see a normalized labor market. The Fed just doesn't want things to deteriorate further from here, which makes perfect sense.
It's interesting, Stephanie. What stood out to me, at least, is when he said, well, I feel a lot better. So I'm happy for him that he is feeling a little bit better about the path to 2% here. But he would not, of course, commit to any definitive answer on the path to lower interest rates. What did you take away from the subtext of what he was saying without saying? Did you get an indication?
I think in addition to what Austan Goolsbee said, and if you take a step back and look at the Fed speakers over the past week and a half or so since the last CPI print, the message has been very consistent among Fed speakers. It's been a message where inflation is coming back down closer towards their target. They're on the golden path, which is exactly how he described it. And the last 2 to 3 prints have been kind of consistent with that. They're emphasizing perhaps even a little bit more the employment side of the mandate versus the labor versus the inflation side of the mandate. So they're starting to get a little bit more concerned on that front. And the rise in the unemployment rate and some of the other labor market indicators are starting to get their attention. So, my sense from hearing the Fed speakers is they're certainly gearing up for a September cut. It seems, and the markets are fully priced for that. And they don't really want to give much indication beyond that. Our base case is that they'll be cutting in September and December, recognizing the market has gotten even ahead of that further and is looking for a November cut. Our base case is the economy won't necessarily be soft enough to warrant that. But the message from him, along with the bulk of the speakers that we've heard over the past 10 days or so, is really just that they're getting ready for a September cut. And the first step of doing a cut is to talk about cutting. So we're making progress on that front, and they're kind of gearing up for that cut. Kind of a little bit early, considering they still have a July meeting ahead of us. Perhaps they just want to ease financial conditions a little bit to help stabilize some of the parts of the economy that they're getting a little concerned about.
Stephanie, what's your base case at this point for rate cuts?
In terms of cuts?
Yeah.
Base cases, we're looking for September cut, December cut. And then we're looking for a quarterly cutting cycle from there, bringing rates back down to about 3.25 to 3.5%. So we think it'll be a very gradual easing cycle, which is a bit unique. But generally speaking, the Fed isn't doing a prolonged easing cycle in a period that's non-recessionary. So as Austan Goolsbee also mentioned, this is a very unique cycle, and this might be just one additional unusual aspect of it, that it's going to be a very slow path towards getting to the trough Fed funds rate, and one that's a little bit less bumpy and less painful than is often the case.
All right, Stephanie, loved getting your insight, your reaction to what we just heard from Austan Goolsbee. Thanks so much for making the time to hop on with us here this morning.